Ladies and gentlemen, good day and welcome to the Grant Thornton's webinar on U.S. tax reforms. As a reminder, all participant lines will be in the listen-only mode. During the course of presentation, if any participant intends to ask questions, they can use the chat box option appearing at the bottom of the screen to submit their questions to the speakers. All questions will be taken up at the end of the session. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Lloyd Pinto, partner at Grant Thornton in India. Thank you, and over to you, sir.
A very warm welcome to all our listeners. Welcome to the Grant Thornton webinar on the Tax Cuts and Jobs Act, a tax reform overview. We live in a globally connected world, and tax and regulatory changes in one part of the world does have far-reaching consequences across the globe. Indian businesses, of course, have significant presence in the US, and thus the recent US tax reforms will have a major impact on how Indian businesses conduct their future operations in the US. On one hand, the significant cut in the corporate tax rates presents exciting opportunities. There are, however, other provisions like the BEAT tax, which are providing some anxious moments to Indian corporates. To talk us through some of these opportunities and challenges, we have with us a very experienced panel of speakers from Grant Thornton, US. It gives me great pleasure to introduce to you our speakers for today. Our first speaker is David Seitz. David is a partner and leads Grant Thornton's International Tax Technical Practice at the Washington National Tax Office. David has extensive experience in US federal income tax planning, tax due diligence, direct and indirect tax planning, foreign tax credit optimization, US inbound and outbound investment, and a variety of other practice areas. Our next speaker is Douglas Wood. Doug is a partner and the national managing principal of Grant Thornton's International Tax Practice. He has over 25 years of dedicated international tax experience, dealing primarily with transactions and related cross-border issues for multinational corporations. Doug has worked extensively advising large vertically integrated manufacturing and technology companies across a variety of matters, including effective tax rate planning. Our next speaker is Raj Tripathi. Raj Tripathi is our national leader for the India Business Group of Grant Thornton LLP in McLean, Virginia. Raj brings more than 15 years of international tax experience. He advises multinational companies on the entire life cycle of doing business in India: investment structuring, setting up an India presence, fund structuring, restructuring of operating and holding structures, transfer pricing, setting up back offices, winding off operations, GST, and corporate law. I now hand over to Raj to take it over from here.
Thank you, Lloyd. Good evening, everybody, and thank you for joining the tax webcast, on the U.S. tax reform. So as you're all aware of, that the U.S. has enacted the first major overhaul of its federal income tax system in more than 30 years by bringing the Tax Cut and Jobs Act of 2017, which is also called TCJA. The tax reform represents a fundamental shift in the way the U.S. taxes the businesses' activities of U.S. multinational companies as well as foreign multinational businesses. The focal point of the tax reform is reduction in the business tax rates and revamp the U.S. international tax system by bringing such reforms, such as quasi-territorial systems with 100% dividend received deduction, one-time tax on previously unrepatriated earnings to specified foreign corporation, global intangible low-taxed income, which is also called GILTI, foreign-derived intangible income, which is your FDII, and also focused on the inbound transaction rules such as BEATS, which is going to be really impacting, a lot of our, companies who are attending our webcast today. That said, we would like to capture some of these, on today's webcast, and my prominent speakers, David Seitz and Doug Wood, will be presenting this in a Q&A session. And so we are looking forward to, questions also from you guys as well. Please feel free to send us the questions, and over to you, Doug, to start the presentation.
Thank you, Raj, and a welcome to everyone again, and thank you for your participation. As Raj noted, we're going to try and keep this a bit conversational today, so there'll be a good bit of back and forth between myself, David, and Raj. We are going to focus on the provisions likely to be of most interest to Indian companies and their investment in the United States, but we're also going to provide an overview of some of the operative changes that relate to U.S. companies and their outbound investment, of U.S. companies' investment, say, in an Indian operation. And then, time permitting, we're also going to cover some baseline matters related to reform that would impact all U.S. companies. And then at the very end, we'll also talk a little bit about what we see perhaps happening next in the sequence of tax reform, and then perhaps some time for questions and answers at the very end as well. So let's dive in straight away. If we could advance to slide number 5. David, let's start off maybe by just give us a quick overview, if you would, of the key provisions that are most likely to be of interest to an Indian company investing in the United States.
Sure. Thanks, Doug. I appreciate that. I think this law, obviously has a variety of components and changes, but there are some very specific provisions that will impact foreign investment into the United States. And probably the biggest one is the base erosion anti-abuse tax, or the BEAT tax, as people have referred to it. And that tax, I think, is a game changer for foreign investment into the United States, and I'll tell you why. We're going to overview how that tax works, but essentially what the Congress has done with the implementation of this law is they have disallowed deductions for certain payments made to foreign-related parties. And so to the extent an Indian company has an investment in the United States and that Indian company is collecting interest income or royalty income from that U.S. company, that U.S. company is now going to have to evaluate their tax liability, not just under our regular tax system, but also under this alternative tax system, which is called the BEAT tax. And the BEAT tax operates, like I said, to disallow the benefit of deductions for payments to foreign-related parties. So in this case, payments to the Indian parent. And so I think what you're going to see is you're going to see a lot of people wanting to change the way they do business and looking at their supply chains in a critical way and saying, okay, if the BEAT tax is going to apply in the United States, I'm effectively being double taxed to some extent. And we'll talk in detail about what the BEAT tax looks like. So that's a big one. The other one I would say that's pretty big are some of the incentives that were put in place for U.S. companies. And one of those incentives is the Foreign-Derived Intangible Income, or FDII. Some people refer to it as FDII. The Foreign-Derived Intangible Income Incentive is designed to allow U.S. companies to benefit from export transactions. And so to the extent you use a U.S. company to hold IP and to exploit that IP either through the sale of products outside of the United States, so export transactions from the United States, or the provision of services to non-U.S. customers, you're going to see a very favorable tax regime in the United States in 2018. And the reason for that is the U.S. company will be entitled to a deduction for income that qualifies for this foreign-derived intangible income regime. And that deduction is going to be one that makes the effective tax rate on that income 13 1/8%. That is a great tax rate from a U.S. tax perspective. So I think you're going to see companies reevaluating, hey, if I'm providing services to global customers, do I want to do that now from the United States? Because I've now gone from a world where maybe that taxable income would be subject to tax at 35%. Now, if I qualify for this foreign-derived intangible income regime, that income is going to be subject to tax at 13 1/8%, which is extremely attractive from an investment perspective. The other rules that you see coming online, we now have hybrid transaction rules. Those rules are very similar to the OECD base erosion and profit shifting rules that are being put in place, for example, through the anti-tax avoidance directives in Europe. Other people have put anti-hybrid provisions online. You've seen the UK put significant anti-hybrid provisions in place. The US now has anti-hybrid provisions in so much as they relate to payments of interest or royalties that are in connection with a hybrid transaction. So we now have to reevaluate how inbound investment into the United States is done. So those are three of the big game changers. We're also going to talk about some of the interest expense limitations that we now have in the United States. But overall, what I tell people is forget what you knew about U.S. tax. It's a whole new world, and there's a whole new paradigm that you need to look at to evaluate your tax planning decisions vis-a-vis the United States.
It certainly sounds like a lot has changed, David, and I agree with you. Perhaps of all of the provisions that would impact investment into the United States, the one that does seem to be getting the most amount or generating the most amount of discussion and conversation does seem to be the new base erosion anti-abuse tax, BEAT. Perhaps we could spend a few minutes going into a little more detail around that. So if we could advance to slide 6, please.
Sure, Doug.
Could you walk us through? Okay.
Yeah. Sorry. Yeah, I'd be happy to. I mean, I think it's important to understand what the BEAT seeks to do so that you can understand how we might plan around it. And so I thought what we'd do is we'd walk through the baseline rules, and then from there we have an example that we'll move into. So what the BEAT is it's a parallel tax system. So you are at a very high level, you calculate your tax under the regular tax system. Your tax will now be calculated at 21% of your taxable income less credits. And then you're going to take and you're going to do a parallel calculation where you're going to do your BEAT tax. And your BEAT tax is going to be your regular taxable income, but determined without regard to what they're calling base erosion payments and certain NOLs that relate to base erosion payments. So in order to be subject to the BEAT, you have to have a certain qualifying threshold of revenue and a certain qualifying threshold of base erosion payments. So that's very important to understand. U.S. companies, in order to be subject to the BEAT, must have $500 million of gross receipts over a 3-year annual period, and they also must engage in a base erosion payments that are at least 3% of their total deductions. So that $500 million number clearly is a signal from Congress that we are looking for companies, large companies, on a relative basis that engage in base erosion. I will point out, because I know from an Indian perspective, it's very popular to have a branch, for example, in the United States. To the extent a foreign company has branch income in the United States or a piece of their business that's subject to tax in the United States, that foreign company's gross receipts that are effectively connected with the United States count towards this $500 million threshold. So, for example, if I'm an Indian company, I have a branch in the United States, and that branch does $300 million of U.S. revenue, and I also have an Indian subsidiary that does $250 million of U.S. revenue, and those numbers are all relatively equal over a 3-year period, you will see that those two numbers get added together and you're subject to the BEAT tax. That being said, the $500 million does knock a lot of people out. So if you have $500 million, if you are at a certain base erosion percentage, i.e. your payments to related parties that are deductible exceed 3% of your total deductions, you're subject to the BEAT tax. And so you calculate your modified taxable income, and then you apply the BEAT percentage. Now, we got a break for 2018, and the BEAT percentage is only 5% of your modified taxable income. Starting in 2019 through 2025, the BEAT percentage goes up to 10%. After 2025, the BEAT percentage goes up to 12.5%. So from my perspective, I'm seeing a lot of companies that aren't necessarily going to be impacted by the BEAT in 2018, but they expect that the BEAT is going to be more of a problem in 2019 when the rate doubles to 10%. So, finally, I think it's important to understand what a base erosion payment is. And as I mentioned, a base erosion payment is essentially a deductible payment made by a U.S. company or a U.S. branch, and that payment has to be made to a foreign related party, and that payment has to give rise to a tax benefit in the United States. And so most payments like royalties, interest, management fees, and payments for services, just about any deductible payment can be considered a base erosion payment and therefore would not be deductible for BEAT purposes. There are significant exceptions, though. The significant exceptions are as follows. Payments that are considered to qualify for what we call our services cost method, that are made to a related party. So payments that are generally for services that don't require a markup. So these are very routine back office services like accounting, certain IT services, stuff that's not really value add, but is just being charged out by a parent company or a group company that kind of manages that service. So if the U.S. company makes a payment to a related party and it's a payment that is a services cost method payment, which is not subject to a markup, that payment's not considered a BEAT payment. Certain derivative payments, to the extent you are in the business of trading derivatives, those payments made to related parties are not considered a BEAT payment. Certain payments that are subject to U.S. tax because they are withholdable are either all or partially exempt from being considered a base erosion payment. So, for example, if I make an interest payment to a related party, and that's a deductible payment, so it would otherwise be a base erosion payment, if that interest payment is subject to a 30% withholding tax, that interest payment, because it's already been subject to U.S. tax, won't be considered a BEAT payment and won't be considered non-deductible for your BEAT tax calculation. And finally, I left the best for last, Doug, cost of goods sold. So to the extent you are in the business of purchasing product for resale to a customer and you incur costs associated with that product, including certain costs that aren't directly associated with that product but are deemed to be part of your cost of goods sold. Cost of goods sold are not considered BEAT deductions. So what that means is you get the benefit of your cost of goods sold when calculating your BEAT deduction, even if you purchase products from related parties. Now, the important thing to point out here is Cost of goods sold is expressly limited to cost associated with products that are purchased for resale. So one of the issues that's come up and a lot of people are concerned about is, well, what if I'm a service provider in the United States and I pay a related party to provide me services that then I provide to my customer? That seems a lot like cost of goods sold. So let's say that I operate a customer service business, and my business is I sign contracts with major companies. When their customers need telephone support, they call my business. I subcontract that business out to a service center, perhaps in India, and I make a payment to the service center in India, but the U.S. company collects the revenue from the customers. It appears that under the application of the BEAT tax, that payment made to a related party in India that's deductible would not be a good deduction for BEAT purposes. So essentially, there's going to be a 10% tax if the BEAT otherwise applies on the offshoring piece of a U.S. business. Very important for this group to understand, and something that I think is going to cause people to, reevaluate their supply chains, to decide, do I want to contract with my customers in a different way, and how do I manage this issue associated with service payments? If we can move on to slide 7, do you think it would be informative, Doug, if we walk through an example?
Yeah, I think it would be very helpful. Maybe just drill down a little bit into that last point you made. So it does seem like the application of BEAT could really have a differential impact on different industry settings. Would you agree with that?
Yeah, I would say yes, absolutely. I agree with that. I think we're finding that technology, pharma companies, knowledge-based companies are not faring as well under this tax bill in general when compared with companies that are heavy industrial manufacturing type companies, people who are making physical products that are heavy machinery intensive companies. And we'll go through some of the other provisions in the bill, but when you think about things like expensing of fixed assets, which we now have in the bill, accelerating our depreciation, when you think about encouraging export sales and tying certain incentives to wage increases, all those things lead you to believe that, hey, businesses that manufacture products and that are in the consumer industrial product space, as opposed to businesses that are in the technology or the pharma or the life sciences space, those businesses that are product based seem to be doing better under the tax bill than the technology based companies. Not sure if that was from a policy perspective. I mean, I certainly think there's a faction of our government that believes that the way you jumpstart our economy is you bring manufacturing back home. There's not a lot of focus on the digital economy in this bill, which I think is perhaps a missed opportunity for the United States to have gotten in front of some of the digital economy issues that we have. But yeah, I mean, there's definitely a disparate effect with respect to the BEAT on those two different types of businesses.
Hey, David, it's Raj over here. While you walk through the example, I just wanted to pose one more thing, when you're walking through the example. I know that the 10% BEAT payment will be an extra cost to the Indian headquartered companies, that are operating in the U.S. And do you think, while you walk through the example, any suggestion or thought from your side on exploring ways to retain their competitiveness? Should the Indian companies, what should they really thinking about from business strategy purposes? If you could also add to that example when you walk us through, that would be helpful.
Yeah, I'd be happy to. So let's take a look at the example, and I think we can think through, what might happen here. So here you have a foreign parented group with a U.S. sub, and we've presupposed that the U.S. sub has $500 million and sufficient BEAT payments such that the base erosion and excise tax would apply. We've assumed that the U.S. person's interest payment is fully deductible and not subject to a limitation under any other provision. We've assumed that neither the interest or the royalty payments that are made in here are subject to a U.S. withholding tax. We've assumed that we are in the 10% 2019 taxable year, that there's no business credits, and that this is not a group that previously went through an inversion under U.S. tax law. So if we can move on to slide 8. You'll see here that the U.S. group, USP, which is in the left side of the org chart, USP is making an interest payment to the foreign parent who's a related party. They're also making a royalty payment to FS1, and then FS1 makes a royalty payment to FS2. You also see that USP's subsidiary, USS1, is purchasing products from F1, which is also a subsidiary of USP. And so the issue here is, okay, with all these transactions, how does the BEAT tax work? And then we'll talk about how maybe we could realign some of this structure in order to get a better answer. So let's walk through the BEAT computation that's on this page. You can see that revenues from third parties for the U.S. parent are $150 and $3,500. So you have consolidated U.S. revenue of $3,650. You can see the cost of goods sold. That's the payment from USS1 for product purchases made to F1. That $750 deduction is allowable both on a consolidated regular tax basis and for BEAT purposes, which leaves you with gross income of $2,900 in both instances. Now, here's where the BEAT payments come in. USP is making an interest payment. That interest payment is deductible for regular tax purposes, and as I mentioned, it's not otherwise subject to a limitation. However, it's not deductible for BEAT purposes because it doesn't meet any of the exceptions, and so the interest payment would be considered a base erosion payment and not deductible in the BEAT calculation. Similarly, the royalty here that's paid from USP to FS1 is a royalty which is not subject to withholding. It's a deductible payment by a U.S. person, and it's made to a foreign related party, so it's not subject, it doesn't qualify as a deductible payment for BEAT purposes. So you can see that for regular tax purposes, the $650 was deductible. For BEAT purposes, it's not. And then we have our selling, general, and administrative expenses, which are generally considered expenses, in our example, are generally considered expenses that are paid to unrelated third parties, and so those payments would be fully deductible. So this is where the math becomes very clear. You can see that on a consolidated U.S. basis, we have $275 of taxable income at 21% tax. You'd owe $57 of tax. Under the BEAT computation, you've got obviously $950 more of taxable income. So you've got $1,225, and that $950 are the disallowed interest and royalty payments. And that's subject to tax at 10%. And so you end up with a BEAT liability of $122.50. The BEAT liability is higher than the regular tax liability. So the way this works is you pay the $57 of regular tax and $64.75 of BEAT tax. And so you end up with a total liability of $122.50. It's important to point out this is a final tax. There's no credit for the fact that you paid BEAT tax one year and that you might have to pay regular tax the next year. There's no carryover, carry back, anything like that to offset the cost of this. This is a real cost in the year that it's incurred, and that's something that companies need to take very seriously. Now, to Raj's point, what do we do about planning here? And maybe if we flip over to slide 9, we can walk through some of the results here and talk about what some of the planning would be. And I think we kind of walked through, the reasons for this, but if you have any questions about why something came out the way it did, this walks you through all the analysis of how we arrived there. But let's think about the interest payment, for example. USP is making an interest payment to a foreign parent, and that foreign parent either lent that money into the United States from excess capital that the foreign parent wanted to redeploy, or that foreign parent has external debt that the U.S. parent is benefiting from through a back-to-back loan. So if the foreign parent went out and borrowed $1,000 and they loaned that $1,000 into the U.S. parent, the foreign parent's really just acting as a conduit on the borrowing. In that case, it might make sense to evaluate, well, should we go to our lender and should we say, hey, lender, we'd like for the U.S. company to be party to our debt agreement, and we'd like for them to borrow $1,000 directly, maybe with or without a foreign parent guarantee. And then all of a sudden, the U.S. Company doesn't have a deductible payment to a related party. They have a deductible payment to a bank who's an unrelated party, and that deductible payment to an unrelated party is not a base erosion payment under the definition of BEAT. So you would eliminate that disallowance of that $300 deduction. Similarly, with the royalty payments, I think you'd want to look and say, well, we have IP that's located in FS1 and FS2. Does it make sense to somehow move the U.S. rights to that IP to a U.S. company? And I know for folks on the phone that are familiar with U.S. tax planning, that would seem silly to have said 6 months ago. But now we live in a world where it makes sense to evaluate whether or not FS1 or FS2 should move that payments back to the United States. So, Raj, there's plenty of planning that can be done. I think the BEAT payment is one. The BEAT tax is one that everybody needs to be evaluating. The good news is, given that it's only 5% for 2018, there is time to plan. But plan you must, and I think it's important that we get started on that.
Absolutely, thanks, and David. I have one more question on the same slide. So as you alluded earlier, that the Indian headquarter companies work in the branch or subsidiary model in the U.S. And the U.S. branch or subsidiary, they do enter into a contract with the U.S. customers, and when they enter into contract with the U.S. customers, 80% of the work is offshore, and then maybe sometimes 20% or 15% is onshore, And the remuneration that they make is at arm's length for the sales and marketing effort that they do, because the U.S. is a branch or a subsidiary model. They have the, and the U.S. is purely sales and marketing, structure that they have set up. Do you think that arm's length payment from the U.S. branch or subsidiary to parent company, which is your effectively connected income with the U.S. trade or business, will be subject to BEAT tax cost? What is your thoughts on that?
Yeah, I think it's a complicated question, and it's one that's going to be very fact specific, and one that's going to be driven by the contractual terms and the legal characterization of the transactions. That said, I do have significant concerns that in that setup where you have a Indian parent and a U.S. company that's providing services to a customer, and that U.S. company makes a payment back to the Indian parent for offshoring of a piece of those services, that seems to be a fact pattern that the U.S. Government seems specifically interested in. And they seem to have incentive to look to disallow that payment under the theory that that payment is designed to erode the U.S. tax base. Now, what's ironic is that payment's not really designed to erode the U.S. tax base in this case. It's just so happens that what you have is an Indian company providing services to a U.S. customer through a U.S. company, and that U.S. company is acting kind of as a conduit. So in those situations, we're talking to customers about, in the absence of guidance that would tell us that that transaction is not going to be a BEAT payment, why not consider, can I restructure that contract with my customer? Is my customer willing to contract with the Indian parent company, for example, for those offshore services? Or is that customer willing to contract with a different legal entity somewhere else in the structure, if not the Indian parent, that's not the U.S. company? And you eliminate the need for the U.S. company to pay a service payment for 80% of their income, which may not be deductible for BEAT purposes. Because after all, I mean, when you think about this, there's a element of double taxation here. You've got if you had a $100 transaction, you had an $80 payment from the U.S. to the Indian parent. that $80 is going to be subject to BEAT tax at 10%, and it's going to be subject to tax in India again. Now, a lot of commentators have come out, and including myself, and said, hey, how's this treaty compliant? I mean, how does this work? We have a double tax agreement with a lot of these countries that this is going to apply to, and isn't this, in effect, double taxation? And, is it appropriate for the U.S. to have a law that seems to be in direct compliance with some of the basic tenets of our bilateral income tax treaties? And so I think we're going to see some activity there. I think we're going to see some countries say, hey, let's go to competent authority and talk about this, because we have Indian companies in this case that are being double taxed. Now, I think we're far down the road on that, and companies are left in the meantime to consider restructuring around this to avoid the problem. But I don't think this is the last we've heard of that issue.
Well, no, thank you. That's really helpful, because at the end of the day, the contractual agreement is what the company should be thinking about, and we can help them and advise them on how to structure the global operation and also the supply chain, and look at the contract. So that's really helpful. Thank you, David.
No
Doug,
problem.
to you.
So if it's fair to say that on balance, BEAT represents a new challenge related to global tax planning, maybe let's look at something that's a little more of a bright spot. So if we could advance to slide 11, David, you mentioned when we were overviewing the provisions that might be of most interest to Indian folks investing in the United States. Let's go back and talk in a little bit more detail about that FDII provision that you mentioned.
Yeah, thanks. This is a great one. So, I like to say, if you eat a lot of vegetables, every once in a while you get a treat, and this is a treat that came with a lot of vegetables in this tax bill, and this treat is really it's an export incentive in the United States, and which is kind of ironic because certain export incentives around the world have come under fire in recent years, but the United States thought it was appropriate to institute a regime that awards U.S. companies, and this is very important, U.S. corporations only. So if you're a U.S. corporation and you have export transactions, you are going to be entitled to a deduction for 37.5% of your net taxable income associated with those export transactions. And that it results in an effective rate when you say, all right, I got a 37.5% deduction, so 62.5% of my income is subject to tax at 21%. I effectively end up with a 13.125 effective tax rate on those earnings. And so that is the rate that'll be in play until December 31st, 2025. So that's one that's worth looking at, because 2025 is a long time away. Who knows what we'll have by then? So this is a good incentive to consider. Let's talk about what qualifies. So the way that this works is Congress thought it was appropriate when they wrote the bill that you should be entitled to this beneficial rate to the extent you export product or services from the United States and the income associated with that export is associated with the intangibles that you hold in the United States rather than the tangible assets. So in an effort to isolate the income that was associated with the exploitation of intangible assets, what they said was, okay, what we're going to do is we're going to look at all of your income that you earn from export transactions, and then we're going to subtract from it the portion that we think relates to a tangible asset return. Okay, so if we could go to slide 12, there is a calculation that's done, and a U.S. company looks at their tangible asset base, and they say, of that tangible asset base, how much of it relates to export activity, and then how much, and then they get a 10% return on those tangible assets. So if you have $1,000 of tangible assets measured at U.S. income tax basis, your $1,000 will attract a 10% return. That means that $100 of your income is deemed to be from your tangible assets. Now, if you have $500 of total income associated with export transactions, and we're talking about net income here, you're going to say, all right, I have $500 total, 100 is associated with my tangible assets, so 400 is associated with my intangible assets and qualifies for this deduction. That is a very high-level example of how this works, but that's the theory behind it. The theory behind it is you look at your total export net income and you subtract your deemed return on your tangible income to arrive at what you think your intangible income is. This is a great opportunity for service businesses that export their services to non-U.S. customers. And I will tell you why. You can have a situation in the United States where if the United States is providing those services or is earning a significant margin on providing those services, they're signing the contract with the customer. That customer is a non-U.S. person, so those services are being provided to a non-U.S. person. The margin earned in the United States associated with that transaction could qualify for this reduced tax rate. And so very attractive benefit in the United States. Again, only available to C corporations. So if you're operating as an Indian company through a branch in the United States, this would be a reason to consider switching to a C corporation. Again, only eligible for export transactions. I will also point out it does not matter where the product is actually made. In previous iterations of U.S. export incentives, there was a focus on domestic production. In this case, it's simply a deduction that's allowable to companies for exporting of product or services, not necessarily related to any required domestic production. So that is the foreign-derived intangible income deduction, a bright spot for taxpayers that can get those benefits.
Hey, David,
Or
can I ask you a following question on that, So,
yeah.
So if the Indian companies will be, operating here in a branch model, they may consider to switch over to a C corp. But what about the intangibles? If the intangible is parked outside U.S., should they be considering moving the U.S. intangible to the U.S.? Would that be ideal? Something that on a long run, to get the benefit?
Yeah,
of
I mean,
the
look,
LTII?
I think there's a big evaluation point there. I mean, there's a lot of reasons to consider moving your intangibles to the United States now, including, the benefit of the 13% FDII rate. But I mean, even if you don't qualify for FDII on every transaction associated with your intangible, you could see a 21% rate, which is still a great rate. I will say this. With the onset of the BEPS initiative, and I don't want to get too far into BEPS, but with the OECD's base erosion process or project, you're seeing a lot of countries that have exit taxes now. And so you've got to be very careful if you consider, hey, I want to move IP to the United States, there could be a very significant tax cost on the other side of that transaction that people need to evaluate. So it's certainly time to look at your global organization and say, what gives me the most efficient answer globally? But the United States is now a big piece of that, Raj, and that is something that I think people should evaluate.
Thank you. Appreciate it.
Before we leave the discussion about the provisions that are of particular interest to inbound investment in the United States, let's quickly go back and talk a little bit more about financing structures, David. I know the U.S. has historically had provisions that limit the amount of deductible interest in certain situations where the lender is a foreign-related party. What's changed in this area? And maybe if we could advance to slide 13 to set that stage.
Yeah, so a big change in this area, and the change is, as we get to slide 13 here, the change is that the interest deductions that are allowable in the United States are now subject to a limitation, and it's not just for related party interest. It's for all interest. And that limitation is driven by taxable income modified. So think about earnings before interest, taxes, depreciation, and amortization. So for the next 4 years, for 2018 through 2022, taxpayers are able to deduct 30% of their tax EBITDA. So that could be a pretty big number if you're, and this is one of those situations where, if you're capital intensive and you have a lot of depreciation and amortization, then this is beneficial to you. So if you have a lot of machinery and equipment, if you're a technology company and you don't have a lot of depreciable stuff on the books, then maybe you don't get as much benefit here. But let's say your tax EBITDA is, $3,000, you're roughly going to be entitled to deduct up to, $900 of interest in the United States. The rest of that interest is going to be disallowed and carried forward. Now, traditionally, we didn't have limits like you mentioned, Doug, unless you had an interest payment to a related party. And then we had some limits which were kind of similar to this, but perhaps a higher percentage was allowable. Now you really need to think about, hey, where do I need to put my global debt? Do I have my global debt aligned with what my EBITDA is? And I will tell you that our deduction limit here, our interest, is very similar to what a lot of major OECD countries are putting online, and we're seeing a lot of countries have interest limitations. And the countries are just simply saying, hey, look, don't load up our particular country with all the group's debt and make us bear all the expense, because essentially that country subsidizes the capital of other countries if they do it that way. And so the United States, no different, has put in a law that says, hey, look, we're only going to give you 30% of your tax EBITDA. Now, EBITDA is pretty generous, right? Because if you take your taxable income and you get to add back your depreciation and amortization, you've got a pretty high number. The post-2022, you don't get your depreciation and amortization add back. The reduction becomes even more narrow, and it's just EBIT. So you're going to see a more harsh deduction limitation post-2022. I will point out that there are exceptions to this rule. Businesses with less than $25 million in gross receipts are not subject to this rule. Public utilities and real estate businesses, I don't know how relevant that is to folks on the phone, but U.S. real estate businesses do not have a limitation on deductible interest. So very important to think about, something to consider. I'm seeing a lot of companies, again, looking at their global structure and reevaluating, where do I want to put my debt?
Fascinating, and it certainly sounds like there's a lot to digest here for folks outside the United States investing into the United States. That being said, and I know we don't have a lot of time left, there certainly are situations where someone outside the United States might invest into the United States, and in turn that U.S. company might hold an investment outside the United States, a sandwich structure, if you will. And perhaps given some of the changes taken in totality, that sandwich structure might become even more common. So let's advance to slide 16. And David, maybe just give us a quick overview of some of those provisions that are really going to have a significant impact on U.S. outbound investment.
Yeah, I think it's a great question. So the biggest change, obviously, is we went from a worldwide system. So we went from a system where U.S. companies were subject to tax on all of their earnings wherever earned, but we had deferral. And what that meant was if a U.S. company earned money through a foreign subsidiary that they owned, so a subsidiary company, the U.S. company would pay tax on those subsidiary earnings when they were repatriated to the United States through a dividend. So the old name of the game used to be, don't repatriate money from your foreign subsidiaries because it's going to cause a 35% tax to materialize, and it's very tax inefficient. So the U.S. wanted to end that lockout effect, and so what they did was they shifted away from that worldwide system of deferral, and they moved to what I call a quasi-territorial system, where they allowed for certain earnings of foreign companies to be repatriated to the United States without any additional U.S. tax. And so that's a very important development. That gets us, I think we were one of two major countries without a territorial or participation exemption on the books. So big development there. In order to get there, we transitioned from the worldwide system to the territorial system. We had to do something about all the prior earnings that were out there. So there were a bunch of unremitted earnings, if you will, that had never been subject to U.S. tax in foreign subsidiaries because people wanted to avoid having the U.S. tax liability associated with the payment of that dividend. So the government, recognizing this, said we're gonna clean out the system, if you will. We're gonna hit the reset button. We're gonna force a deemed repatriation of all those earnings back to the United States, and we're gonna tax those earnings on a one-time basis at a lower rate than would otherwise apply. So the way they did this mechanically was they said, as of December 31st, 2017, for calendar year companies, you're deemed to repatriate all of your foreign earnings. To the extent those earnings were held in cash or cash equivalents, we're going to tax you at 15.5%. To the extent those earnings were held in non-cash assets, we're going to tax you at 8%. It's immensely more complicated than what I just described, but that's the general theory behind it. Now, everybody's previous earnings have been subject to tax in the United States. 8% is not a bad deal. 15.5% is not even a bad deal, considering the deal was 35% before. You do get some benefit of foreign tax credits if you paid taxes in the local country on those earnings previously. So that's a huge calculation. That's something that a lot of U.S. companies are dealing with now. That's something that U.S. companies are recording as part of their financial statements. It's a big deal. And I think from a global investment perspective, you now have to understand that there's a lot of capital that's now free to move into the United States for reinvestment that before was kind of locked out of the United States. So I think we're going to see some companies, we recently saw Cisco announce that they're going to repatriate $67 billion to the United States. There's been a number of other companies that have announced that they're going to invest more in the United States. So certainly a big development there. Now, moving to a territorial system opened up the potential for a lot of abuse. And the concern was U.S. taxpayers now could structure their operations such that they earn all of their foreign income in a very low tax jurisdiction, and then they could repatriate those earnings to the United States under our new system and not pay any additional tax. And so in order to avoid that situation from occurring, the Congress put in a global minimum tax, and this is what's called GILTI, Global Intangible Low Taxed Income, and it's a very, very complex provision, but essentially what it is it's a minimum tax on foreign earnings of U.S. companies, and it works this way. If you pay at least 13% tax on your foreign earnings, you're probably not going to suffer any additional U.S. tax. If you pay something less than that, you're going to have an immediate U.S. tax in the year that those earnings occur, and you're going to pay that tax immediately in the United States under this GILTI regime. So what we got a quasi-territorial system with a global minimum tax and a one-time tax repatriation. So truly a landscape change, Doug.
It certainly is. Maybe turn for a minute on that GILTI provision. I know we've got a specific slide. If we could go to 23. There may be a bit of an anomalous result here in terms of some of the way the incentives are provided. That routine return on depreciable assets gives you a floor, I suppose, where you could earn non-U.S. income and return it to the United States under the dividends received deduction. Do you see the possibility that this is going to actually provide a bit of incentive for people to invest in hard assets outside the United States?
Yeah, look, I certainly think there's that opportunity, and I've certainly heard tax planners and taxpayers talk about this, so, hey, I get a benefit if I invest in tangible assets outside the United States. And we didn't talk a lot about the calculation, but similar to the foreign-derived intangible income, where they're trying to isolate your intangible income inside the United States, the global intangible low-taxed income is trying to isolate your intangible income outside the United States. And so what they do there is they say, we're going to look at your earnings outside the United States, and anything you earn over and above a 10% return on your depreciable assets is going to be considered global intangible income, and to the extent it's subject to low tax, you've got a pickup. Now, what that means is they're not going to tax, as you mentioned, Doug, that 10% return on depreciable assets. So people start to look at this and say, well, should I build a plant outside the United States because I get a 10% return on my depreciable basis there, and I can earn that money in the local country and then repatriate that to the United States without any additional tax. I will tell you this, the big driver of that is what tax rate you can get in the country where you're investing. And so to the extent you can get to a place where you are earning that money in that country at a low enough rate that it makes sense to invest in that country, and you're comfortable that you're going to have a long enough run life on those assets that you're going to get that 10% return every year and it's going to shelter enough income, you can see a mathematical situation where it makes a lot of sense. Now, I will tell you that that rate has to be pretty low because your alternative is to invest in the United States and to get 21% or 13% if you're exporting product. So companies that are fairly mobile and can decide with relative ease of restriction where to invest their assets are certainly thinking about this math. And it is kind of a perverse incentive to invest outside the United States, which is exactly what I don't think the current policymakers were shooting for. So it's a little bit of a head scratcher on that front.
Yeah. Certainly an opportunity, if nothing less, to do modeling. All of these rules are susceptible to calculation, and being able to model out these results and then do some what-if scenarios around where you do what in your global supply chain. I think that's going to be an area of acute focus as we move forward. We've got just a few minutes left before the close here. There's a lot of material in the slide deck related to some general provisions in tax reform that are going to impact U.S. companies. So please feel free to review that on your own and get back to any of the speakers here with questions. But in the few minutes that we have left, maybe let's advance to slide 36. And David, I know that this all sort of hit at the very end of the year. The passage of the act happened. A lot of people were speculating that perhaps it wouldn't even happen. Given the rush to the finish line, if you will, maybe just a few closing thoughts on what comes next.
Yeah, so that's very interesting. So what comes next is a whole lot of uncertainty. And the reason I say that is we have a 500-page tax bill with a whole set of new tax regimes in it. And we are left in a situation where we need an immense amount of guidance from the administrators of the tax system, and that is the IRS and the Treasury. And they are working hard to provide us with the guidance, but there's simply some things where we don't have answers. And taxpayers are going to operate for the next, I would say, 18 months in a very uncertain environment. And they're going to have to make decisions about how they operate their business, how they structure their business, and how they make investments with less than perfect visibility into how the U.S. tax system is going to apply to that. And so what I'm encouraging people to do is to reach out and to talk with their advisors and understand a couple of things. The first one is what positions are becoming commonplace in your industry. So look to your industry peers and say, what positions are they thinking about? what positions are they taking, and then compare and contrast your options and say, do I want to be an outlier on this, or do I understand why the industry is in that position? Think about how your business might be best planned to insulate yourself from some of that uncertainty. I know a lot of taxpayers say to me, geez, I just really want certainty. I want to know what my taxes are going to be. So let's plan into what we think the most certain answers are. And we can certainly help advise people on where we think there's safety in this tax bill and where we think that there's risk. But, you know, I don't think we're going to see much more guidance, Doug, and we talked about this a little bit yesterday. I really think it's going to be late fall, winter of 2018, perhaps before the holiday season, so more than a year after the bill was enacted, before we see comprehensive regulations from the Internal Revenue Service on this bill. And so in the meantime, we're all going to be left to exercise our best judgment and to make reasonable choices about how we think this bill should apply. That presents both opportunities and challenges.
Yeah. Certainly the proverb, may you live in interesting times, has never been more true. Thanks for those observations, David. I know that we're just a bit over time here. Raj, I'm going to turn it back to you for any final thoughts.
Sure. Thanks, Doug and David. Really appreciate it. And I think there were a lot of questions that I had in my mind that we wanted to pose, but this is something that because of the time, we could not. But I would like to end this, that if there are any questions that we were not able to address, please reach out to any one of us. And this is the first of the webcasts on tax reform. We will be following up with another one coming up soon, which will be really focused on, what the impact is going to be on the federal side, the state side, and sales and use tax side. So please look out for another invite coming out soon on the next webcast on the tax reform. And thank you, everybody, for participating, and have a wonderful weekend. And please reach out if there are any questions that is still in your mind and you are not able to ask us. Thanks, everybody.